Imagine you're chatting with a friend over a steaming cup of coffee, and the conversation turns to money, specifically, taxes. One of you says, "I got a raise, but now I'm worried I'll make less because I'll be in a higher tax bracket, and all my money will be taxed at that new, higher rate." Sound familiar? This is perhaps the biggest, most persistent myth about how tax brackets work, and it's holding countless people back. What if I told you that fear is almost entirely unfounded? That's the surprising truth we are diving into today. Welcome back to the channel. Today, we are going to unravel the mystery of tax brackets. Forget the jargon and the scary headlines. Think of me as your friendly guide, explaining this complex topic over that same cup of coffee. By the end of this video, you'll not only understand how tax brackets really work, but you'll also see why this knowledge is a superpower for your personal finances. No more worrying about that raise or bonus. You'll be empowered to make smarter money decisions. Let's dive in. First things first, what are tax brackets? In simple terms, they're income ranges that are taxed at different rates. Think of your total taxable income, which is your gross income minus certain deductions, as a pie. Tax brackets are like imaginary lines that slice up that pie into different segments. Each segment, or bracket, gets its own specific tax rate. It's how many countries, including the United States, implement a progressive tax system. This means that as you earn more money, higher portions of your income are taxed at higher rates. The key term here is progressive tax system. This system is designed so that individuals with higher incomes pay a larger percentage of their income in taxes than those with lower incomes. It's often viewed as a way to promote fairness and redistribute wealth. But here's where the common misconception kicks in. Many people believe that if even $1 of their income falls into a higher bracket, then their income is suddenly taxed at that higher, new rate. And that, my friends, is simply not how it works. Here's the surprising truth, the core secret to understanding tax brackets. Your income is taxed in *chunk star. Each chunk, up to the limit of a specific bracket, is taxed at that bracket's rate. Once that bracket is filled, any additional income then moves into the next bracket and is taxed at its rate, and so on. It's like filling buckets. You fill the first bucket with water, your income, up to its limit. Then the overflow goes into the next bucket, and so on, each bucket having a different pour rate. To illustrate, let's use some simplified hypothetical tax brackets for an individual, just for our example. Please remember these aren't the actual current federal tax brackets, which change annually and have more complexity. For our purposes, let's say 10% on income up to $10,000. Then, 12% on income from $10,001 to $40,000. And finally, 22% on income from $40,001 to $90,000. Anything above that would be taxed at an even higher rate. Ready to see it in action? Let's introduce Sarah. Sarah is a recent college graduate, working her first job, earning a taxable income of $35,000 a year. She's heard the scary tax bracket rumors and is a bit nervous. Using our simplified brackets, how much tax does Sarah actually owe? This is where the chunk-by-chunk secret really comes to life. We don't just multiply $35,000 by a single rate. Instead, we break her income down according to our bracket structure. Okay, let's calculate Sarah's taxes. Her first $10,000 of income falls into the lowest bracket, taxed at 10%. So, $10,000 multiplied by 10% is $1,000. This part is straightforward. Now, Sarah's total income is $35,000. We've accounted for $10,000 of it. That leaves her with $25,000 more to be taxed. This remaining $25,000 falls into our second bracket, which covers income from $10,001 to $40,000, taxed at 12%. So, Sarah has $25,000 of income remaining. This full $25,000 fits entirely within the 12% bracket, which goes up to $40,000. So, we take that $25,000 and multiply it by 12%, which gives us $3,000. To find Sarah's total tax bill, we simply add the tax from her first bracket, $1,000, to the tax from her second bracket, $3,000. Her total tax for the year comes out to $4,000. Notice how no part of her income was taxed at a rate higher than 12%. So, Sarah's total tax bill is $4,000 on her $35,000 taxable income. This means her effective tax rate the actual percentage of her total income that she pays in taxes, is about 11.4%. That's significantly lower than the 12% or potentially higher rates she might have feared if she believed the all-income taxed at the highest bracket myth. This shows the progressive system working exactly as intended, taxing only portions of her income at increasing rates. Now, let's talk about the infamous tax cliff. This is the fear that many people have. If your income just barely crosses into a new, higher tax bracket, you'll suddenly owe a lot more in taxes, potentially losing money or even having less net pay than someone earning slightly less. It's a common source of anxiety when considering a raise, a bonus, or even taking on a side gig. But as you're about to see, this cliff is actually more like a gentle slope, or even just a tiny bump in the road. Let's meet Mark. Mark is a hard worker and is up for a promotion. Currently, his taxable income is $39,999. In our simplified bracket system, he's just under the $40,000 threshold, meaning the highest rate his income touches is 12%. He's excited about the promotion, but his colleague warned him about the tax cliff. He's worried that if his new income is, say, $40,001, he'll be penalized massively. Let's crunch the numbers for Mark to see if his fear is justified. Mark's current taxable income is $39,999. Let's calculate his tax bill using our brackets. First $10,000 is taxed at 10%, which is $1,000. The next chunk of his income, from $10,001 up to $39,999, is $29,999. $39,999 to $10,000. This $29,999 is taxed at 12%, which equals $3,599.88. So, Mark's total tax bill at $39,999 is $1,000 plus $3,599.88 equals $4,599.88. His net income would be $39,999 to $4,599.88 equals $35,399.12. Now, let's say Mark gets that promotion, and his taxable income becomes $40,001. Just $2 more. How does his tax bill change? First $10,000 at 10% is still $1,000. The next $30,000, from $10,001 to $40,000, is taxed at 12%, totaling $3,600. Now, here's the magic. Only that extra $1 from $40,000 up to $40,001 falls into the next bracket, which is 22%. So, $1 taxed at 22% is just 22 cents. His total tax, $1,000 plus $3,600 plus 22 cents equals $4,600.22. Mark's tax bill went from $4,599.88 to $4,600.22, an increase of just 34 cents, even though he moved into a new bracket. His net income at $40,001 would be $40,001 to $4,600.22, equals $35,400.78. Compare this to his previous net income of $35,399.12. He actually takes home $1.66 more . So, earning $2 more in gross income meant he kept $1.66 more net. The tax cliff is a phantom. You always keep the vast majority of any extra dollar you earn, even if it pushes you into a higher bracket. This brings us to two crucial terms: marginal tax rate and effective tax rate. Your marginal tax rate is the rate at which your last dollar earned is taxed. In Mark's case at $40,001, his marginal rate is 22%, because that $1 extra dollar was taxed at 22%. Your effective tax rate however, is the total percentage of your income you actually pay in taxes, calculated by dividing your total tax paid by your total taxable income. For Mark, his effective rate at $40,001 is about 11.5%, $4,600.22, $40,001. So, if the tax cliff is a myth, why does this confusion persist? A few reasons. First, taxes are inherently complex, and the language used can be intimidating. Second, media often oversimplifies or sensationalizes tax discussions, focusing on the highest bracket rates without explaining the progressive nature. Third, and perhaps most significantly, it's tied to our natural aversion to losing money. The idea of a raise costing us money is scary, even if it's unfounded. It's a psychological barrier to financial growth. Understanding this surprising truth has significant real-world implications for your money and your life. Let's revisit promotions. Many people shy away from asking for a raise or accepting a promotion because they fear the tax cliff. Knowing that only the additional income is taxed at a potentially higher rate empowers you. You can confidently negotiate, knowing that virtually every extra dollar you earn from a promotion will result in more take-home pay for you, even if your marginal rate increases. The same principle applies to bonuses. Ever heard someone say they didn't want a bonus because it would push them into a higher tax bracket? This is a classic example of the myth in action. Yes, a bonus might be taxed at your highest marginal rate, but that's only the bonus itself not your entire year's earnings. And even then, specific withholding rules might make it seem like more is taken out initially, but it evens out when you file your taxes. A bonus always means more money in your pocket. What about taking on a side hustle? Many aspiring entrepreneurs or freelancers worry about the tax implications of their additional income. They might hesitate to grow their business because of perceived tax penalties. But understanding that new income is incrementally taxed means you don't need to fear success. While self-employment taxes, like Social Security and Medicare, add another layer, knowing how income tax brackets work allows you to accurately forecast your take-home pay and budget accordingly. Now that we've demystified tax brackets, it's time for a turning point in our understanding. Tax brackets are just one piece of the puzzle. The real power comes from understanding how deductions and credits fit into this system. These aren't just obscure terms on tax forms. They're powerful tools that can significantly reduce your taxable income or even directly lower your tax bill. Think of them as the secret weapons in your financial arsenal. Let's start with deductions. A tax deduction reduces your taxable income star. Remember our income pie? Deductions effectively shrink the size of that pie before we start applying the tax bracket percentages. This means a smaller amount of your income is subject to taxation at all rates. For example, if your income is $50,000 and you have $5,000 in deductions, your taxable income becomes $45,000. That's a huge difference because it potentially moves money out of higher brackets and into lower ones. Tax credits are even more powerful. While deductions reduce your taxable income credits reduce your actual tax bill dollar for dollar star. If you owe $4,000 in taxes and you qualify for a $1,000 tax credit, your tax bill immediately drops to $3,000. It's not about which bracket you're in. It's a direct reduction. This is a crucial distinction. Credits are pure gold, and understanding how to identify and claim them can make a massive difference to your financial outcome. With this full understanding, how tax brackets work, plus the power of deductions and credits, your goal shifts from fearing taxes to optimizing your taxable income. It's about strategically using the rules to keep more of your hard-earned money. This isn't about avoiding taxes. It's about paying only what you legally owe and not a penny more. This proactive approach is a cornerstone of smart personal finance and can free up significant funds for savings, investments, or simply enjoying your life more. Let's quickly imagine a small drama. Meet John. John heard about the tax cliff myth and didn't understand progressive taxation. He got a small raise that nudged him into a new bracket. Believing he'd now be taxed at the higher rate on all his income, he deliberately didn't adjust his W-4 withholdings. He figured they'd take enough out. But since his actual effective rate was still lower, and he didn't account for other income or missed deductions, he ended up with a nasty surprise tax bill come April, despite his income technically increasing. John's situation, though simplified, highlights why understanding these basics truly matters. His fear of a higher tax bracket was unfounded, but his misunderstanding of the system led to a genuine financial headache. If he had understood marginal versus effective rates and how withholding works, he could have adjusted his W-4 explored potential deductions, and avoided the stress and the unexpected payment. This isn't just theory, it's about practical, everyday money management that affects your peace of mind. One important caveat: while we focused on federal income tax brackets, many states also have their own income taxes, and they operate in similar, often progressive, ways. Some states have flat tax rates, while others have no income tax at all. It's crucial to understand your state-specific tax system in addition to the federal one, as this will further impact your overall effective tax rate and your take-home pay. Always factor in both federal and state regulations when doing your financial planning. So, to recap, what's the core misunderstanding most people get wrong? It's the belief that once your income crosses into a higher tax bracket, your income is then taxed at that new, higher rate. This leads to unnecessary fear about promotions, bonuses, and side income. The truth, as we've explored, is that only the portion of your income within that new, higher bracket is taxed at that rate. The rest remains taxed at the lower rates of the previous brackets. It's a fundamental misunderstanding of the progressive system. This understanding matters for your money in profound ways. It allows you to plan your finances without fear. You can confidently set salary expectations, evaluate job offers, and make informed decisions about investments or retirement contributions that impact your taxable income. It means you won't leave money on the table by avoiding a raise or a bonus. It's about taking control of your financial future, rather than letting myths dictate your earning potential. Your money decisions become truly strategic. Beyond just dollars and cents, this knowledge matters for your life. It brings peace of mind and reduces financial anxiety. No more unnecessary stress over receiving a bigger paycheck. It empowers you to be more proactive, seeking out opportunities for growth, knowing that you'll always benefit. This understanding fosters financial literacy, which is a cornerstone of independence and security. It's about feeling confident and in control, not intimidated by the tax system. So, what's your first actionable step? Go find the actual current federal tax brackets for your filing status. A quick search for IRS tax brackets, current year, will get you there. Understand the income ranges and the corresponding rates. This is your personal map to how your income is taxed. While our simplified example provided clarity, using the real numbers is essential for your actual financial planning. Bookmark that page, because it's a valuable reference. Next, estimate your current or projected taxable income. This isn't your gross pay, but your gross pay minus any pre-tax deductions like 401k contributions, health insurance premiums, or traditional IRA contributions. Knowing this number helps you see which brackets your income fills and which marginal rate your next dollar will be subject to. This is where understanding your pay stub becomes incredibly useful. Don't be afraid to pull it out and really look at the numbers. Third, start exploring common deductions you might qualify for. Are you contributing to a traditional IRA? Do you pay student loan interest? Did you itemize last year? Or would the standard deduction be better? There are many ways to legally reduce your taxable income, even without a fancy accountant. Resources from the IRS, reputable financial blogs, or a tax professional can help you uncover these opportunities. Every dollar deducted from your taxable income reduces your tax burden, often more significantly than you might expect. Finally, investigate tax credits that could apply to you. Are you paying for higher education, American Opportunity, or Lifetime Learning Credit? Do you have dependents, child tax credit? Are you saving for retirement, retirement savings contributions credit, or savers credit? These are just a few examples of credits that can directly reduce your tax bill. A $1,000 credit is a $1,000 reduction in what you owe, which is incredibly powerful. Don't leave these valuable savings on the table. The big picture here is empowerment. Understanding how tax brackets really work, differentiating between marginal and effective rates, and knowing the impact of deductions and credits transforms you from a passive taxpayer into an active financial participant. You are no longer held back by common myths, but rather equipped with knowledge to make informed decisions that benefit your wallet and your peace of mind. This is truly one of those fundamental financial lessons that everyone should know. So, the surprising truth about how tax brackets really work is that your entire income isn't suddenly taxed at a higher rate when you get a raise or bonus. Instead, Your income is taxed progressively, in chunks, with each portion falling into its respective bracket and being taxed at that brackets rate. This means you always keep more of any extra dollar you earn. The tax cliff is a myth, and understanding this protects you from unnecessary financial fears. I hope this deep dive has demystified tax brackets for you and given you the confidence to approach your finances with new clarity. Remember, knowledge is power, especially when it comes to your money. If this explanation helped you, please give this video a thumbs up, share it with someone who might still be fearing the tax cliff, and subscribe for more friendly financial explainers. What other tax myths have you heard? Let me know in the comments below. Stay savvy with your money, and I'll see you in the next one.